Hello! Welcome to Capital Sensei. Today, we're going to dive deep into a book that has fundamentally changed the way many people think about money. Secrets of the Millionaire Mind by Harv Eker. We're not just going to skim the surface. We will dissect the core concept of your personal financial blueprint, the subconscious programming that dictates your entire financial life. Then, we will walk through, one by one, the 17 specific wealth files that detail the mental and habitual differences between the rich and the rest. Whenever we can, we answer questions in the comments. This topic often brings up a lot of personal reflections and very specific doubts. So please, feel free to share your thoughts, your own money stories, or any questions you have. Creating a community where we can all learn from each other is a big part of what we do here. Let's start with the central pillar of the entire book. Eker argues that your financial success or failure is not primarily determined by your education, your intelligence, the economy, or your choice of investments. It's determined by what he calls your financial blueprint. Think of it like the blueprint for a house. You can be the best builder in the world with the finest materials, but if the blueprint is flawed, the house will have problems. You can try to repaint the walls or change the furniture, but if the blueprint is flawed, the house will have problems. But the structural issues will remain. Your financial blueprint works the same way. It's your pre-programmed mode of thinking and acting when it comes to money. And here's the kicker. For most of us, this programming happened when we were children, and we are completely unaware of it. It's like a thermostat. If your financial thermostat is set to, say, $72,000 a year, and you suddenly get a bonus that pushes you to $100,000, you will subconsciously find a way to get rid of that extra $28,000. You'll overspend, make a bad investment, or face a sudden emergency, bringing your wealth back down to your comfort zone. Conversely, if your thermostat is set to $1 million and you lose money in the market, bringing you down to $500,000, you will work, innovate, and strive relentlessly until you're back at that $1 million mark. The blueprint is your financial set point. The outside world, your income, your savings, your net worth, is simply a printout of this internal program. So, the only way to permanently change your financial life is to change the blueprint itself. So where does this blueprint come from? Eker identifies 3 primary sources of our mental conditioning around money. The first is verbal programming, what you heard when you were growing up. Think about the phrases that were common in your household. Was it things like, money doesn't grow on trees, rich people are greedy, we can't afford that, or money is the root of all evil? These aren't just harmless sayings. They are files being downloaded directly into your subconscious mind, creating your beliefs about money. If you constantly heard that wanting to be rich is a bad thing, you might subconsciously sabotage your own success because you don't want to be one of those bad rich people. You'll associate wealth with negative character traits. This creates an internal conflict. Part of you wants financial freedom, but another part of you believes that being rich would make you a bad person. In this internal battle, the deeper emotional programming almost always wins. The second source of conditioning is modeling. What you saw when you were growing up. Children learn far more from what their parents do than what they say. How did your parents manage money? Were they frugal or were they big spenders? Were they savvy investors? Or did they avoid the topic of investing altogether? Did money cause arguments in the house, or was it a source of joy and security? For example, if you had a parent who was a shopaholic, constantly spending to get a temporary emotional lift, You might either replicate that exact behavior, or you might swing to the complete opposite extreme and become an obsessive saver who feels guilty spending even a single dollar on enjoyment. Either way, your behavior is a reaction to the model you observed, not a conscious choice made from a place of balance and awareness. The third and final source is specific incidents, what you experienced around money. These are often powerful, emotionally charged events from your childhood that left a lasting impression. Maybe you asked your father for money for an ice cream cone and he exploded in anger about how hard he works and how you don't appreciate it. In that moment, your young mind could have forged a powerful equation. Asking for money equals humiliation and pain. Fast forward 20 or 30 years, and you find yourself unable to ask for a raise at work, or you feel intensely uncomfortable negotiating prices for your services. You might not consciously remember the ice cream incident, but the emotional programming is still running the show, holding you back. Your blueprint is telling you that asking for what you're worth is a dangerous and painful act. Recognizing these influences is the first step. Eker proposes a 4-step process for change. First is awareness. You recognize that a certain belief you hold is just a product of your past programming. Second is understanding. You see where that belief came from, the things you heard, saw, or experienced. Third is disassociation. You realize that this belief is not actually you. It's a file from the past. You have the choice to keep it or discard it, just like an old file on a computer. And finally, the fourth step is reconditioning, which he calls a declaration. You state a new, empowering belief out loud, anchoring a new thought pattern. This is where we get into the 17 wealth files. These wealth files are the core of the book. They are 17 specific ways that rich people think and act differently from poor and middle-class people. This isn't about judgment. It's about identifying patterns. As an economist, I see these as mental models that lead to predictable financial outcomes. Let's go through them. Wealth file number 1. Rich people believe, I create my life. Poor people believe, life happens to me. This is the difference between being in the driver's seat and being a passenger. People who struggle financially often play the role of the victim. They blame the economy, the government, their boss, their spouse, everyone and everything except themselves. You'll hear them complain, justify their situation, and blame others. Complaining is focusing on what's wrong. Justifying is saying things like, well, money isn't that important anyway. And blaming is pointing the finger at external factors. Economically speaking, this is about locus of control. An internal locus of control, the belief that you are responsible for your outcomes, is a massive predictor of success. Millionaires take 100% responsibility for their results. If an investment fails, they don't blame the market. They analyze what they could have done differently. They believe they are the creators of their own economy. Wealth file number 2. Rich people play the money game to win. Poor people play the money game not to lose. This is a huge distinction. Think about it in sports. Is there a difference between playing offense and playing defense? Of course! When you play not to lose, your primary goal is survival and security. You take a job with a stable paycheck and focus on paying the bills. Your financial goals are modest, like having just enough to retire comfortably. When you play to win, your goal is massive wealth and abundance. You're not just looking for comfort, you're looking for freedom. This mindset dictates your actions. The not-to-lose player puts their money in savings accounts or low-yield bonds, terrified of risk. The to-win player understands calculated risk and invests for significant growth in assets like stocks and real estate. The intention is completely different, and intention determines results. If your goal is to be comfortable, you'll likely achieve it, but you won't get rich. Wealth file number 3. Rich people are committed to being rich. Poor people want to be rich. There's a universe of difference between wanting something and being committed to it. Wanting is passive. I want to be rich, but I don't want to work too hard. I want to be rich, but I'm scared of losing money. I want to be rich, but it would mean I have to pay more in taxes. These are mixed messages. You're telling the universe you want wealth, but your subconscious is listing all the reasons you don't. Commitment is unconditional. It means being willing to do whatever it takes within legal, moral, and ethical bounds. It means dedicating your time, energy, and capital. It means learning new skills and stepping outside your comfort zone. Most people aren't willing to make these sacrifices, which is why they never get rich. They aren't fully 100% committed. Wealth file number 4. Rich people think big. Poor people think small. This comes down to the law of income, which Eker states as, you will be paid in direct proportion to the value you deliver according to the marketplace. The key word here is marketplace. How many people do you serve or affect? If you're a massage therapist who works one-on-one, there's a hard cap on your income because there's a limit to how many people you can personally help in a day. You're thinking small. But what if you created a system to train other massage therapists in your unique method? What if you opened a chain of wellness centers? Now you are serving thousands of people, and your income potential explodes. You are thinking big. It's about scale. Do you want to play in the minor leagues or the major leagues? The rewards are vastly different, but it starts with the decision to think on a larger scale. Wealth file number 5. Rich people focus on opportunities. Poor people focus on obstacles. This is a classic glass half full versus glass half empty scenario, but with financial consequences. When presented with a new venture, a person with a poor mindset will immediately see all the reasons it could fail. What if it doesn't work? What if the economy crashes? I don't have the money for this. They are operating from a place of fear, and their mind is a master at risk identification, but not opportunity assessment. A person with a rich mindset sees the same venture and focuses on the potential for growth. This could be a huge success. How can we make this work? They see potential, not problems. They perform their due diligence, of course. They're not reckless, but their default setting is to look for the upside. This leads them to take calculated risks that the obstacle-focused person would never even consider. And it's those risks that often lead to the greatest rewards. Wealth file number 6. Rich people admire other rich and successful people. Poor people resent rich and successful people. How can you become something you resent? It's impossible. If your subconscious mind believes that rich people are evil, greedy, or dishonest, it will protect you from becoming one of them. You will sabotage any chance of accumulating wealth because on a deep level, you don't want to be one of them. This mindset is often fueled by envy and a scarcity mentality. It's the belief that if someone else has a big piece of the pie, it means there's less for you. Rich people operate from a place of abundance. They understand that there is plenty to go around, and another person's success doesn't diminish their own. They look at successful people as role models, as sources of inspiration and learning. They think, if they can do it, I can do it too. Wealth file number 7. Rich people associate with positive, successful people. Poor people associate with negative or unsuccessful people. This is the law of association. You are the average of the 5 people you spend the most time with. Energy is contagious. If you hang around people who are constantly complaining, blaming, and talking about problems, that negativity will seep into your own thinking. Their limiting beliefs will reinforce your own. Conversely, if you spend time with people who are talking about opportunities, investments, business ideas, and personal growth, their mindset will rub off on you. You'll start to see possibilities you never saw before. It's not about ditching your old friends, but about consciously choosing to spend more of your time with people who lift you up and model the success you want to achieve. Wealth file number 8. Rich people are willing to promote themselves and their value. Poor people think negatively about selling and promotion. People who struggle financially often have a negative association with selling. They think it's sleazy, pushy, or beneath them. This often stems from a lack of belief in their own product, or more deeply, a lack of belief in themselves. If you truly believe that what you have to offer, be it a product, a service, or your own skills at a job, can genuinely help people, then it's your duty to let as many people as possible know about it. Promotion is simply sharing your value. Rich people are fantastic promoters. They are passionate and enthusiastic about what they do, and they're not afraid to tell the world about it. Refusing to promote is a huge obstacle to wealth. Wealth file number 9. Rich people are bigger than their problems. Poor people are smaller than their problems. The secret to success is not to try to avoid or get rid of your problems. It's to grow yourself so you are bigger than any problem. Think about it. A problem for a 5th grader, like a difficult math equation, is no problem at all for a college professor. The problem didn't change. The person's capacity to handle it did. When you are a small person, any little problem seems like an insurmountable obstacle. A flat tire can ruin your whole week. But when you grow yourself through personal development, learning, and experience, you become a bigger container. The same flat tire is just a minor inconvenience that you handle and move on from. Rich people don't shrink from problems. They face them head on because they know that overcoming challenges is how they grow stronger and more capable. Wealth file number 10. Rich people are excellent receivers. Poor people are poor receivers. Many of us have been programmed to believe it is better to give than to receive. While giving is wonderful, this belief creates an imbalance. If everyone only gave and no one received, who would the givers be giving to? For every giver, there must be a receiver. People who are poor receivers often feel unworthy or undeserving. When someone pays them a compliment, they deflect it. When someone gives them a gift, they feel obligated to give something of equal or greater value back immediately. They are uncomfortable receiving. This closes them off to the flow of abundance, including money. You have to be willing and open to receive all the good things life has to offer, including wealth, without guilt or feelings of unworthiness. Wealth file number 11. Rich people choose to get paid based on results. Poor people choose to get paid based on time. This is one of the most direct economic principles in the book. There is nothing wrong with a steady paycheck, but it comes with a major limitation. Your time is finite. There are only so many hours in a day. By trading your time for money, you are putting a ceiling on your income. Rich people, on the other hand, prefer to be paid for the results they produce. They often work on commission, own their own businesses where their income is tied to profits, or get paid through profit sharing or stock options. This removes the ceiling on their income. Their earnings are not limited by the number of hours they work, but by the scale of the value they create. It's a riskier path, but the potential rewards are exponentially higher. Wealth file number 12. Rich people think both. Poor people think either or. People with a poor mindset live in a world of limitations. They believe you can either have a successful career or a close family. You can either have money or be happy. You can either have a delicious cake or have a healthy body. This either-or thinking forces false choices. Rich people live in a world of abundance and ask, how can I have both? They believe you can have your cake and eat it too. How can I have a great business and plenty of time for my family? How can I be financially successful and a genuinely happy spiritual person? This kind of thinking forces your mind to be creative and to look for solutions instead of accepting limitations. They want it all, and they believe it's possible. Wealth file number 13. Rich people focus on their net worth. Poor people focus on their working income. Society often asks, how much do you make? This focuses on working income, the paycheck. While income is important, it's only one part of the equation. The true measure of wealth is net worth. Net worth is simply what you own minus what will owe. It's the final scorecard. You can have a very high income and a very low net worth if you spend everything you make. Think of professional athletes who earn millions but end up broke. Conversely, a person with a modest income, like a school teacher, can become a millionaire by diligently saving and investing over time, building a high net worth. Rich people understand this. They track and focus on growing their net worth, not just their paycheck. This net worth is comprised of 4 key factors: income, savings, investments, and simplification. Income is your cash flow in. Savings is what you keep. Investments are how you make your savings grow. And simplification is about consciously designing a lifestyle that requires less money to maintain, which allows you to save and invest more. Focusing on all 4 is the key to building real wealth. Wealth file number 14. Rich people manage their money well. Poor people mismanage their money well. This might sound obvious, but its importance cannot be overstated. It doesn't matter if you have a lot of money or a little. You must develop the habit of managing what you have before you can get more. It's like a law of the universe. If you can't be trusted with $100, why would you be given 100,000? Eker suggests a simple but powerful system. He recommends dividing your after-tax income into several accounts. For example, 10% into a financial freedom account, which is for investments only and never to be spent. 10% into a long-term savings for spending account for big purchases. 10% for education. 10% for play, an account you must spend every month to build your receiving muscle and have fun. 50% for necessities. The exact percentages can be adjusted, but the principle is what matters. Have a system and manage your money consciously. Until you show you can handle what you've got, you won't get any more. Wealth file number 15. Rich people have their money work hard for them. Poor people work hard for their money. A core tenet of financial freedom is that you eventually need to stop trading your time for money. The way to do that is to have your money start working for you. Every dollar you save and invest is like a little employee whose job is to go out and earn more money. This is the magic of compounding. Poor people see a dollar and think of it as something to be spent. Rich people see a dollar as a seed that can be planted to grow a money tree. They work hard initially to build up a money army, and then that army of investment dollars goes to work for them 24 hours a day, 7 days a week, generating passive income. The goal is to reach a point where your passive income exceeds your expenses. At that point, you are financially free. Wealth file number 16. Rich people act in spite of fear. Poor people let fear stop them. This is not to say that rich people are fearless. They feel fear, doubt, and worry just like everyone else. The difference is they don't let those feelings stop them. They understand that comfort is the enemy of growth. Your comfort zone is directly proportional to your income zone. If you want a bigger income, you have to be willing to get uncomfortable. Action is the bridge between your inner world and your outer world. Poor people wait until the fear subsides before they act, which means they often never act at all. Rich people feel the fear and do it anyway. They train their minds to be more powerful than their emotions. They understand that real growth happens just outside the boundaries of what feels safe and familiar. And finally, wealth file number 17. Rich people constantly learn and grow. Poor people think they already know. In today's rapidly changing world, if you're not learning, you're falling behind. People who are struggling financially often believe they know everything they need to. They're quick to say, "I know that," when presented with a new idea. But as Eker puts it, if you're not rich and happy, there's a good chance you don't really know it on a level that produces results. The most successful people I know in any field are perpetual students. They read books, attend seminars, hire coaches, and are always looking to upgrade their skills and knowledge. They are humble enough to admit they don't have all the answers. The phrase, "I know that," is a defense mechanism that shuts down learning. The mindset of the rich is, "I can always learn more." They understand that their own growth is the ultimate form of leverage for creating wealth. So there you have it. The entire philosophy is built on a simple but profound premise. Your programming leads to your thoughts. Your thoughts lead to your feelings. Your feelings lead to your actions. And your actions lead to your results. To change the fruits, you must first change the roots. By becoming aware of your financial blueprint and consciously choosing to install these 17 wealth files, you are fundamentally changing the cause, which will inevitably change the effect, your financial reality.